scruffy teenager in thick glasses, penniless except for borrowed money, stands on the chaotic floor of the Chicago Mercantile Exchange, shouting bids, barking orders, all through his father's fingers, because he's not yet old enough to trade. That kid would go on to turn a tiny $1,600 into hundreds of millions, and then challenge the very idea of talent. No MBA, no Wall Street pedigree, just a relentless belief that anyone could be a market master. But how did he do it? And could anyone actually pull it off? Keep watching, because his next move would spark one of the wildest experiments in financial history: humble beginnings. The Chicago kid Richard Dennis was born in Chicago, 1949, in a tough neighborhood on the South Side. No silver spoon, just grit. As a teen, he worked as a runner on the trading floor. Mind you, he wasn't even 18 yet. He convinced his father to trade for him until he was old enough. He also flirted with philosophy, reading Hume and Locke, learning that knowledge comes from experience, not birthright. That blend of street smarts and open-minded thinking would shape his edge. Soon after college, he borrowed $1,600, spent $1,200 on a trading seat, and plunged into the markets with just $400. By his mid-20s, he'd turned that into over $100,000 and then into millions. This was no fluke. It was 1970s, chaos, grain shortages, inflation, perfect conditions for trend following. But there was something deeper. Dennis believed markets weren't mystical, they were patterns anybody could follow. He'd prove it. Soon, he made $1 million by age 25, but his next move would shock Wall Street. But first, where does belief end and proof begin? That brings us to his boldest bet yet. The big bet: can anyone trade? On one hand was Dennis, a man with no fancy degree, but extraordinary success. On the other was his friend Bill Eckhart, a brilliant mathematician who believed trading skill was innate genius. Dennis thought traders could be trained, Eckhart thought they could not. So they made a bet. In 1983, Dennis placed a daring classified ad in the Wall Street Journal offering 2-week intensive training and cold capital to strangers willing to learn. Thousands applied. He picked 14 novice CSVs, from Air Force pilots to blackjack pros, a piano player, even a fantasy game creator. He called them turtles because, like turtle farms in Singapore, he believed he could grow traders. But growing traders is one thing. Making them millionaires? That's another challenge entirely. And next, you'll see why his training looked more like a military boot camp than finance school. Training the turtles. Rules, discipline. And forget charts cluttered with lines. Dennis taught just a few clear rules. Buy when a market hits a new high, sell at a new low. Use breakouts. He taught them risk math. Never risk more than 1-2% of their capital on a single trade. Use stops, manage size based on volatility. Then, pyramid smartly when trades win. In 2 weeks, these rookies memorized numbers. 20-day breakouts for entry, 10-day breakouts for exit. They learned position sizing based on ATR. No guessing, no gut feelings. This wasn't hype, it was a formula. And once the training ended, the real test began. But first, what happened in those first few months would either break them or make them legends. Up next, the first trades, turning 250,000 into millions. After training, each turtle got a demo account. Then if they survived month 1, real money, between $250,000 and $2 million each, from Dennis himself. At first, markets zigged and zagged, choppy range-bound action that wiped out many early. Trend traders lose a lot before they win big. Only the toughest stuck it out. But by following the rules, the survivors rode big trends in commodities, currencies, bonds. They didn't predict, they reacted. And in just 5 years, those 14 turtles combined for $175 million in profit. This sent shockwaves through Wall Street. Not only did they beat the markets, they proved trading wasn't magic. It was a skill that could be coded and taught. However, as soaring success came, so did the dangers. What Dennis taught them didn't always work, and he would face a moment that no training could prepare them for. Crash and reckoning, Black Monday, 1987. On October 19, 1987, the infamous Black Monday, the stock market plunged 22%. Futures markets went haywire. Dennis wasn't immune. He lost an estimated $10 million that day and nearly $50 million total through 87-88. Some of that disaster was due to deviation. The turtle still followed rules during extreme chaos, and rules sometimes break during panic. In 1990, investors sued, claiming he didn't stick to his own system. He paid $2,500,000 to settle without admitting guilt. He stepped away from managing money for a while, but the turtle experiment had already rewritten what everyone thought about trading. One man's bet on teachable skill had set new rules for the elite. Yet, not everyone believed this approach would last. But how many of those turtles went on to build their own empires? That's next. Turtle legacies. What came after? Not all turtles flamed out. In fact, many thrived. Jerry Parker launched Chesapeake Capital, managing billions. Liz Cheval, Paul Rabar, Tom Shanks, they all stayed in finance, adapting what Dennis taught them. Curtis Faith, who joined at 19, made $30 million during the experiment. Later, he wrote Way of the Turtle, spilling the secrets of what works and why discipline is gold. Others faded away. But here's the key. His experiment didn't just create traders. It created stories, tools, systems. Turtle rules appeared in books. The BBC even made a show called $1,000,000 Traders in 2009, trying to recreate his experiment during the financial crisis. The world couldn't get enough, but one question always pops up. Did teaching trading talent kill its edge? Many say yes, and it led to a shift in markets. Strategy or fad? When trends fade. Trend following was gold until it wasn't. By the mid-90s, algorithmic traders started to crowd the same breakouts. False moves skyrocketed. Trend systems began choking. Modern backtests of turtle rules show flat returns from 1996 to 2009. Markets changed. Yet the core, risk control, position sizing, exit rules, stayed relevant. Today, versions of the turtle system are automated, but it demands discipline, sticking to rules even when they hurt. Only a few succeed. Maybe that's part of Dennis's secret. It wasn't that trading could be taught. It was that mastery meant enduring the pain when rules don't pay off. Yet. So, is Richard Dennis a legend or a cautionary tale? That brings us home. Richard Dennis took a street-smart kid's grit, mixed it with philosophy and discipline, and bet the farm that trading could be taught. He taught everyday people his rules, and they nearly doubled his money with almost no experience. He rewrote what people thought was possible on Wall Street. But his journey also shows a hard truth. Rules can guide you, but when storms hit, they can break. Many turtles thrived, many didn't. Markets evolve, systems falter. Yet what Dennis built wasn't just a win streak, it was a legacy. A legacy showing that systems matter, discipline matters, and sometimes the greatest power lies in believing you can teach yourself to win. Richard Dennis didn't just dominate his Wall Street moment. He proved that under the right conditions, the biggest barrier isn't lack of talent, it's lack of belief. And if you can believe, you just might make your own legend in the markets. Like this video and subscribe to the channel. Your support will be remembered.